Zacks Rank Buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zacks Rank Buys. You know, each stock within the Zacks Rank Buy universe is chosen based on how well it matches criteria comprising the four main investing styles: aggressive growth, growth in income, momentum, and value. Today, we talk about some aggressive growth stocks with Bill Wilton, our new aggressive growth stock analyst at Zacks.com. You've brought three stocks with you here, William, starting with First Solar, FSLR, ticker symbol, traded on the NASDAQ, right?
Correct.
They recently announced an expansion at their Ohio plant. Are they based in Ohio?
Actually, they're based in Arizona.
Okay.
But they are going to be expanding their Ohio plant by about 500,000 square feet, increasing the capacity, adding over 130 jobs. Mm-hmm. So it's good for the company, good for the area. And this is also a much-needed expansion, as they've got about $6 billion in sales booked through 2012. So this is going to bring their United States plant up to speed, along with their other plants located in Europe and Malaysia.
So is all of this expansion what puts them on the aggressive growth track?
That's definitely a factor, but the biggest thing here is, it's given the current events, fuel prices being volatile where they are, the push for green energy, renewable resources makes this a very attractive industry. Recently, a lot of other solar stocks have sold off because they're actually afraid of a glut on supply of solar panels. But like I mentioned before, First Solar has almost $6 billion worth in sales booked through 2012.
All right. Then on the 23rd of September, you wrote about RadioShack Corporation, RSH, the ticker symbol. Mm-hmm. What puts this company on the aggressive growth track?
Well, they've actually just seen a nice boost in comparable stores year over year. They're up about 6.9%. They're seeing a lot of strength with GPS systems as well as digital converter boxes. As you know, national broadcast is going to switch over from analog to digital early next year. Right. So they are reaping a lot of benefits there. Their current year and next year estimates are up about an average of 15.5% over the past couple months. So they're seeing analysts take a liking to this stock, and a lot of the attention lately that management has been putting on the company is they're focusing on individual stores, which is something they really haven't done before. They're remodeling 14 stores completely and updating over 4,000 stores across the country, including redoing their management structure to put an emphasis on in-store management and then work its way up to the top rather than the top down.
Interesting. Mm-hmm. And then on the 19th, you wrote about Big Lots, BIG, the ticker symbol. They are not just a dollar store anymore, huh?
Yeah, correct. In the slow economy, people are looking for ways to stretch a weakened dollar. What better way than a discount retailer? The other interesting part about Big Lots is that they're a closeout retailer, so they take products that are no longer even offered anywhere else, give people one last crack at them. So it also offers a sense of urgency, saying that these products are no longer available anywhere.
Right.
So you're getting a deal. You're getting almost of a one-of-a-kind shopping experience every time you go there. So there's different offerings all the time.
All right. What about aggressive growth stocks in general? What are some of the hallmarks that you as an aggressive growth stock analyst look for when you're trying to isolate these aggressive growth stocks?
Well, a lot of it has to do, with the projected growth rates. You'll look at what analysts are expecting of these companies, and then, granted valuations or conservative pricing is a big part of that also. So you'll look for a conservative PE ratio. For example, Big Lots is a 1.0, not PE ratio, PEG ratio, which is the PE ratio divided by the growth. Mm-hmm. That means you're getting your growth rates at a reasonable price. 1 is typically the cutoff. Anything over that is categorized as relatively expensive, depending on the industry that you're in. Anything under 1 is considered a good bargain. You're getting the growth rates at a fairly attractive rate. So that's one of the main things that I look for is, not just growth rates, but you want to be getting them at a decent valuation.
All right, Bill, thanks. We'll talk to you next time around. Do you or does anyone in your household own any of these stocks that we talked about?
No, we do not.
All right. Earnings estimate revisions are the most powerful force impacting stock prices. You hear us say that all the time. We also tell you that the Zacks Rank takes full advantage of changes within those estimates to help investors become more profitable. And each day on Zacks.com, Zacks Rank buy stocks for the various investment strategies are spotlighted. You can read about those stocks by linking to them off of our homepage, Zacks.com. They're just right there for you to link to in the upper right-hand corner of the homepage. With Bill Wilton, I'm Terry Ruffalo.